futures and options. I have been getting a lot of queries asking me to explain this difference. So I thought I will do a video on this. So first let me explain you futures. So now I will take an example of Reliance. Let's say Reliance is currently trading at 2000 rupees per share. Now you are a person who is ultra bullish on Reliance. You feel that Reliance will go to 2500, 3000 or whatever. But you have 1 lakh capital with you. So with 1 lakh capital, you can buy only 50 equity of Reliance. So you can divide 1 lakh by 2000. So you will be able to buy only 50. So here I am not considering the brokerages, taxes and other part. For simplicity, I will just take it as 2000. Now, if you are really confident of Reliance going up, then you can buy one lot of futures. In futures and options, you should always trade in lots. So now let's say the lot size of Reliance is 250. So now with the capital of 1 lakh, which is the margin money which you will be paying to the exchange, you will be able to buy 250 quantity of Reliance. So now if Reliance goes up 100 rupees, you will actually be making 25,000 profit. At the same time, if Reliance falls 100 rupees, you will be making a loss of 25,000. Whereas if you had invested 1 lakh in equity, you were able to buy only 50 stocks. So in 50 stocks, if Reliance goes up 100 rupees, you will be making only 5,000 rupees profit. So this is futures trading. In futures trading, it's not necessary that you have to buy and sell. So tomorrow if you are bearish, if you feel for some reason Reliance is going to fall, in that case you can go and sell one lot of Reliance in the futures market, which you cannot do in the equity market. So now if you sell Reliance at 2000 rupees and if Reliance falls 100 rupees, you will be making a profit of 25,000 because the lot size is 250. You cannot do this in equity market. This is futures trading. Now I will be telling you what is options trading. In options trading, you have two things. One is the call and the other is the put. In options trading, you have two players. One is the option buyers and the other one is option writers or option sellers. So I will take an example of a call. So now let's say Reliance, as I told you, is trading at 2000 rupees. So now let's say there is a call of 2100, which is currently trading at 10 rupees. Okay. So now if you are a call buyer and if you buy 2100 Reliance call at 10 rupees, you will be investing only 250 into 10, which is 2500 rupees is your investment. Whereas if you are a seller of 2100 call of Reliance, then you will have to pay a margin money to the exchange, which will be approximately 1 to 2 lakh rupees. Okay. You can use the margin calculators of various brokers and you will come to know what is the margin. So now as a seller, the investment is 1.5 to 2 lakh investment. Now the buyer will be making a profit only when Reliance closes above 2100. So the more above it closes above 2100, that's when the buyer will be making a profit. So if, let's say, Reliance closes at 2200. So if there is a buyer who has bought 2100 call at 10 rupees, then he has made a profit of 2200 rupees minus 10 rupees, which is 190 rupees into 250. So this will be the profit of a buyer. Whereas the seller will be losing the same money if the Reliance closes at 2200. Now, when will the seller make money? The seller will make money if Reliance closes below 2100. Okay? If Reliance closes anywhere below 2100, it can be 2000, 1800, 1500, whatever, the call seller will be making a profit of 10 rupees into 250, which is 2500. So for a seller, the maximum profit which he can make is this much. But he has to give an investment of 1.5 to 2 lakh. Whereas for a buyer, the investment is only the premium what he pays, which is approximately 2100. The profit potential is unlimited, which means the more the Reliance goes up, the more profit he will be making. But even if Reliance is in sideways or if it goes below, he will be losing this amount only. Okay? So, as a buyer of an option, the profit potential is very high. As a seller of an option, the profit is fixed, the risk is unlimited, and you should be very careful if you are a seller. But in reality, the probability of making profit is very high for a seller. This was about call option. Now I will tell you what is a put option. So even in put, you have a buyer and a seller. So I take the same example where Reliance is at 2200 and a put of 2800. A buyer buys a 1800 put of Reliance at, let's say, 10 rupees. So now as an option buyer, the investment which is required is just 10 into 250, which is the lot size, which is nothing but 2500. Whereas for a seller, even if he is selling a 1800 put for 10 rupees, the investment needed will be 1.5 to 2 lakhs. The profit potential of a put buyer will be high when the stock falls. The more it falls, the more will be his profit. But on expiry, Reliance has to close below 1800 in order for a put buyer to end profitable. So let's say on expiry, Reliance closed at 1700. In this case, this put buyer has made a profit of 100 rupees into 250, which is 25,000. Okay? In this case, the seller would have lost 25,000. The seller will make a profit if Reliance trades above 1800 and closes above 1800 on expiry. The maximum profit which a put seller can make is the premium what he collected, which is nothing but 10 rupees into 250, which is 2500. So as a put seller, the profit is limited, whereas the risk is unlimited. Whereas a put buyer, the profit potential is unlimited the risk is limited to just this much, whatever premium he pays. But in reality, option sellers have high probability of making profit. Okay, I hope this gave you the difference between futures and options. Thank you for watching. Do like and subscribe to my channel to learn more about trading and investing.